Greetings and welcome to another edition of the Ad Astra Kansas Money Talks podcast. I'm Joe Blubon. I'm joined by Mark Johnson and Bob Schwartz of Bob Schwartz Financial. They have offices in Victoria and Silver Lake, Kansas, and you can always find out more information about them online at bobschwartzfinancial.com. And we'd love it if you could subscribe, give us a thumbs up, do all those things that you do on YouTube, and of course, give us a rating. It really helps with the algorithm on your favorite podcast platform. Today there was recently an article that came out from Morningstar talking about 20 IRA mistakes to avoid. And we thought we would take that and run with it a little bit and talk, maybe not go through all 20, but talk about a few of the main mistakes to avoid. And especially as we look at it from a Kansas perspective. We have a lot of ag producers in this state, and maybe turn it to that perspective just a little bit. And I'll kind of get us rolling here. One of the first things that was interesting in the article is they said that there's $15 trillion in IRAs across the United States as of September of 2024. So substantial amount of money in IRAs, but obviously there's some things you want to avoid doing to make your IRA as powerful as it can be. So number one on their list, and really probably one of the biggest, is just waiting too long in life to start contributing to an IRA.
Yeah. The article talks about, two things when it comes to this. The first one being, are you waiting till your retirement age to start funding an IRA? That's a problem. They also talk about each year waiting until April 15th of the year to fund your IRA and not letting it compound through the year. Both those things are problems that you can have with an IRA. The bigger one that I'd say is, that we'd focus on is not waiting till you're older. If you're a parent, grandparent, try to convince your younger, your kids, your grandkids that opening a Roth, especially a Roth in our opinion, or a traditional IRA, getting that open and letting that money compound early is incredibly important.
And when they're younger, at least for the 2025 tax year, it's $7,000 that they can contribute. Doesn't mean that they have to get all $7,000 in there. Any dollar that they put in at that point is going to be important.
Yeah, and that's the one thing about the article that I was not critical of by any means, but when they talk about, not waiting the article is going to talk about, you should put all your money in that $7,000 as soon as you can every year, and that's great for some people that can do that, but not everyone can do that. They might have to fund it through the year, and that's awesome too. Whatever you need to do to be able to fund that. If you're fully funding your IRA, I think that's a great accomplishment in its own.
So, Bob, one of the things that they talked about is, not waiting until April the 15th. Of course, April the 15th of 2025, you can still contribute to a 2024 IRA up until that date. Dollar cost averaging, I think, is the term that they use. Why is that important?
It's by buying monthly. Let's just say that somebody says, I want to put away $625 a month into my IRA. You're investing monthly. So markets move daily. So you're buying each month, and some months you're going to buy higher, and some months you're going to buy lower. But the more sequences that you have in your investment life, meaning the more times you're putting money away during a period of time, whether that's 1 year, 10 years, 20 or 30 years, the more sequence of events you have, that over time is going to give you a better cost average of that investment. And it used to be that April 1st, April 15th was unbelievably busy because everybody'd funded at the end of the year. And here was the phone call we'd get. And I'm talking about 25 years ago. But, my accountant says I have to do an IRA. Otherwise, it had nothing to do with what that was going to do for me in retirement. It was, my accountant said to save money this year on taxes, I need to do an IRA. And we would be covered up from April 1st to April 15th. People bringing in, back then it was $4,000 and putting it away. nowadays people are much better informed because of the internet, because of studying, because of people in our industry that are keeping people aware of it. And if you can't afford an IRA and you're eligible for an IRA, you need to do an IRA. And we help people all the time do that, and that has made our lives much better April 1st to April 15th.
And I would also assume that by doing it monthly and hopefully setting up something automated, it also reinforces the fact that you're just continuously doing it and not missing a month, or maybe you get to that April 15th deadline and you just don't have $7,000 to put in there.
Yeah. Or, okay, that another thing, I'll let Mark talk about it, but it's, well, I can't save $650 a month. Well, you don't have to. I'll let you address that.
Is that with the, are you talking about with ag producers or specifically, or?
Let's say that we have a 25-year-old couple come in and they don't have a 401k at work. They're not participating in it. They're not putting any money in retirement. They've got some money in savings. And, we say, hey, well, you're eligible to put money into a IRA. You can put away $7,000 a year. We'd recommend at your age doing a Roth. And they go, well, we're saving for a down payment on a house. Mm-hmm. And we can't save $1,000 a month for a Roth IRA. Well, can you put away $50 a month?
Mm. Yeah. Yes.
And you're 25 years old. Two key things there: starting A, B, starting out at a smaller amount. That doesn't really matter there because that's going to compound over years because they're so young. So.
Yeah, and if you can make contributions, till that next year's tax year. So it doesn't have to all be, it doesn't have to be that whatever $600 a month figure. If you can just be have discipline and save each month, that's just a start. And let's say you have a big, have a gift or you have something that helps that burden of your down payment come along. You can always fund it a little bit more at times.
Okay, and then. Bob, one of the things that we talked about before we started the podcast and kind of looking specifically to Kansas were those ag producers. And you had mentioned sometimes young ag producers that maybe don't have money at that particular time. There might be some other options that they have as well.
Yeah, one of the things that I've talked about a lot at when I've spoken at ag conferences is when your bank has you do your net worth statement at the first of the year, because you're getting ready to do your line of credit, and you're putting down your expenses, the expenses of putting in your crop, how much is fertilizer going to cost, how much is the fuel going to cost, make a line item in there for retirement, and put down that you're going to put $14,000 or whatever into retirement, and put that down as an expense. Because if you'll do that, I know how ag producers work. They pay off lines of credit. Put money into your retirement. Pay off your line of credit when you do harvest, and move on to the next year. And when I get young ag producers to do that, we're helping them build assets so that when they're 60 or 65 and they're ready to talk with their son or daughter that's working on the farm, talking to them about renting the ground to them, they've got an asset base besides that farm ground. Mm-hmm. And that's so important because a lot of times ag producers want to keep working because they need that income because they haven't built a base up. And if they would have started at 30 or 40 or even 50, putting away like that, and as I say to ag producers all the time, if you have that on your line of credit, you'll pay it off, won't you? And they'll go, yeah, you're right. I will.
Yeah, it's a good point, and that's something that's kind of unique to that industry.
To that
as well.
industry,
yeah.
But every bank requires, if you have a line of credit, they have to send in a net worth statement, and most of them require how much are you going to spend this year getting your crop in the ground, and or at least most of them sit down and put that down. Put down a retirement plan in there. Yep. You will be like I've told ag producers many times, this is the best advice I can give you right there. That's going to save you in your retirement years.
Now, one of the things that I've heard you both talk about, and I know just your philosophy, is that you guys like Roth IRAs. And, I remember when Roths first came out, it was kind of like the thought was, okay, if you're young, it's a Roth. And if you're getting closer to retirement, you don't have as much time to kind of make that worthwhile. So then maybe you want to think about switching to a traditional. Over time, that has morphed, and I think there's a whole bunch of different strategies. But I know you guys both like Roths, but is there times where maybe a traditional might be a better answer than a Roth?
Yeah, there are some tax implications that can make, regular IRA, contributory IRAs, more tax beneficial for people. We, like you said, we really encourage, especially younger people, to really, look at that Roth and take advantage of that, the ability to let your money grow, tax free. That's an incredible thing. But there are some unique scenarios that having a regular IRA could have tax advantages.
Right.
Yeah.
Like if you're making you're making a lot of money now and your income's going to really drop at retirement. Not very many cases of that happens in our practice because people are, people have an asset base that's going to create income for them in their retirement. Mark and I are very pro Roth if you're eligible to have a Roth. A matter of fact, one of the places in today's tax code that is unfair is they have a $200,000 limit on who can do a Roth, but yet you can work at a company that has a 401k and put $26,000 into a Roth. That's not fair. That's not fair to people owning a business and making $220,000 a year. They can't do that unless they have a 401k at that business. So, there's things in the tax code that you can take advantage of. If you have a 401k and you come in to see us and you're 25 years old, Joe, what we're going to tell clients are do Roth, and then once a year, take the contribution that your company made that is traditional 401k and convert that to Roth, because someday you're going to get that tax-free. I don't care what tax bracket you're in, heading into that way. And that's how Mark and I like the Roth. But yeah, there are circumstances where a traditional IRA is better. Another place is ag producers. Ag producers like no taxes. And so the way to do that is a deductible IRA, especially if you're an ag producer that can control your income. So otherwise, you can turn a switch when you go on Social Security. When you start taking money out of your IRA, you can be in a position to have that not be a whole lot of money coming in as income, and you're in a lower tax bracket. So see that sometimes with our ag producers.
You said something I wanted to dive just a little bit deeper into, and you were talking specifically about 401ks. And it is safe, we should have said this at the beginning, is a lot of what we're going to talk about today translates very well, not only to IRAs, but also 401k contributions. You talked about converting the match, which is almost always traditional, converting that to a Roth. Should a person get to zero in their traditional? Because I've always kind of been under the assumption that you would want some money in that traditional account because every year you get the standard deduction and you'll never pay taxes on that. So would you suggest that you keep some in the traditional, or would you convert every year and just always have 100% of your money in Roth?
It depends on what happens to Social Security taxes.
Good point.
If Social Security taxes go away, yeah, you're going to want to keep where you can pull $25,000 a year out today, and of course that's going to be pegged to cost of living. So they're, if they're not taxing Social Security, but if they're taxing Social Security, most people are going to blow by that $25,000.
Yeah, that makes sense.
just on Social Security income. Kansas is not now taxing Social Security.
Yeah, finally.
Great for Kansas.
Yeah, we were one of the last 10 states to do away with it.
I think
We
actually
finally-
7.
So down to 7. Wow. Yeah.
Yeah, and that's again, Mark and I are, and I know Joe, you feel this way. That's a tax on seniors, and that's a tax on seniors that maybe don't have a lot of income.
Right,
So
that fixed income.
it's a good thing for Kansans. And if they got on the federal level, we all paid tax. We all put a lot of money away, and I don't know how they can keep. I have ideas on keeping Social Security solvent, but that doesn't matter what I think. But if they could get where they weren't taxing Social Security for seniors, especially seniors that were in a certain income bracket, boy, would that be fantastic.
And as of this recording, President Trump has now released that as a policy initiative that he hopes to push through, is no federal tax on Social Security. So that'd be a good thing. That would be great.
That'd be a good thing.
And another thing I wanted to dive a little bit into, and it's really another one of the don'ts when it comes to IRA savings. And you mentioned that there are limits. It's right around that $200,000 a year, I think, for married couples. There's different levels, whether you're single or whether you're married, of whether you can contribute to a Roth IRA. And if you at that same income level, I believe, correct me if I'm wrong, but you also couldn't deduct your contribution. So you can't, if you make over a certain amount, approximately $200,000 for a married couple, you not only can't have a Roth IRA contribution, but you can't have a tax deductible IRA contribution. Doesn't mean you can't make an IRA contribution. You can make a non-deductible one, correct?
Yeah, we'll talk about that in a second. Now, if you have someone that's making over $200,000 a year and they don't have a retirement plan at work, they can fund a traditional IRA no matter how much they make.
Okay, very good.
So a case like that might be somebody that has 3 employees and they don't want to contribute for their employees, so they just do an IRA each year. But the other way is let's say somebody has a 401k and their income's too high to do a traditional Roth, and I'll let Mark explain it, but they can do what's called a backdoor Roth.
Okay.
Yeah. So you pretty much the investor gets to have it's pretty much the pro rata rule, right?
Pro rata.
Yeah, pro rata rule. But it allows you to take part in a Roth by converting that money. Even if you make over that limit, which is nice, but Bob likes to tell us it's maybe not necessarily. It's not necessarily in the tax code that it's allowed.
Yeah. But you can go put whatever the limit is, 7,000. You can put that into a traditional IRA, non-deductible. Otherwise, you don't get it deducted off your income. Yep. And then you can immediately convert that to a Roth IRA.
Because you've already paid the taxes on that contribution.
On that contribution. And the IRS has not unfavorably looked at those. And they have been being done for a long time. But they haven't put out a letter that says they're great.
Yeah, there's nowhere in the tax code that says you can do it.
Right. And it's another case of, where things aren't quite level, it's on the playing field. And and I wish they would come out and say whether that's eligible or not. What we really like is when we sit down with clients that aren't eligible for them. We love that because that means they're making money.
Yeah, that's great. Now, one of the things that people have to be careful with, though, when they're making those backdoor Roth, conversions, sometimes there's a tax that is involved with that. So let's say, for example, you make the contribution on, it doesn't matter, you make the contribution, and then maybe you wait 2 weeks or a month to do that backdoor conversion,
Yeah.
you could have earnings in there,
Yeah.
and you're going to pay a tax on that earnings.
Yeah. You don't want to. All of a sudden something goes to the moon while you're waiting to convert it, and all of a sudden you have a tax bill. So don't assume that it's going to be nothing. Make sure you're paying attention to what. If you have that money invested, what's that? What are those gains in that time period between the conversion?
And that's why when we do a backdoor, we always make sure that we just hold the money in cash and then we do the conversion immediately, so that there's no tax ramification on that. Yeah,
that makes sense. But for those that are kind of doing it on their own, you would probably recommend do the contribution on one day, do the conversion the next.
Yes, and Well, the other point being is you could put 7,000 in and say, and just say we had a tremendous market correction that day, and your 7,000 is worth 6,000 when you convert it. You've kind of hurt yourself going forward on that. So
that would be my luck.
Yeah.
Anytime I do
mine
that.
also.
Yeah.
Mine also. Hey, I bought such and such today. Oh, well, it's going to go down tomorrow. Yeah.
So we've already hit it pretty hard that we think that the best advice, get in the market early. Time in the market, is the most important thing. But that doesn't mean that if you're, my age, 52 or older, that you shouldn't. It's too late. It's that's not the case.
Yeah, I think a lot of people don't. The rules change where you can contribute later. Like you can continue to contribute as the retirement. As RMDs have went further, right? That's kind of the reasoning behind that.
Yeah,
well,
RMDs are going to go to 74.
And and one thing you got to think about is a lot of these people are thinking of their Roth IRA as like, oh, this is a great way to give my kids money so that they can withdraw tax free. And so if you want to, that's a great way to keep contributing, to your legacy or your,
But the 10-year rule.
Yeah. But still, it's a good way to keep contributing.
Yeah.
The why
Right.
to keep contributing.
Right. Hey, I'm an old man. I still put money into a retirement plan every year.
Yep.
And I have to take money out each year, but
Yeah.
I'm still putting in, and I probably will as long as I can work. I like to tell a quick story here. I have some dear clients that started with me in the last 10 years. They had zero money saved for their retirement, and they owned a small business. I got them started with IRAs, and then we switched over to a retirement plan with the business for those two and their 4 employees, and they have crossed over $500,000 now in their assets, and they're 74 and 75, and they're still they still work just like a lot of people in Kansas, and they are now over $500,000 in retirement assets, and have a base now that they can feel good about if they want to go ahead and retire, which they don't want to yet, but when they do, they're going to be in a great position. So don't ever think it's 52 is the middle of the game now. 52 when I started 48 years ago was if you don't have any money yet, you're done. It's not that way anymore.
And it's a great place to mention that I believe it's age 50 you get the catch-up contribution as well.
Yep.
So 7,000 this year is the limit for those under 50, but those 50 and over can put in 8,000, I believe. Is that correct?
I think so. Yeah.
I used to have that all memorized.
I know, I do too. But.
Too many numbers.
Yeah.
Too many numbers, but
I believe it's 8,000.
Yeah, I think it's at 8,000 that you can put away if you're over 50, and it's never too late. That's the one thing that I've enjoyed about our Victoria office, and we've got a lot of clients out there that are 50 and plus when they joined us and started their life of investing, and all they'll say is, I wish I'd have started earlier, but I'm glad I started when I did.
Yeah. And while we're talking about this, another thing that is kind of unique about IRAs is first of all, to contribute to an IRA, you have to have some kind of an earned income.
Yeah.
But there are some circumstances where you don't need to have an earned income, and one of those is if you're a stay-at-home spouse. Is that correct?
Yeah, you can, if it's a non-working spouse, and if you're earning enough to cover both IRAs, you can cover a spousal IRA contribution.
And they're at the same limits as the person in the workforce.
So let's take a ag producer, wife teaches school, and their income's under 200,000, which generally farmers are, because they can kind of control things. They're eligible to put away, if they're under 50, 14,000 a year, because we're going to encourage them to do one on their spouse, even though she has a retirement plan and has the opportunity to put money into a retirement. They're still eligible for an IRA. So yeah, the spousal is a great method. Even if they don't have income, you can put away for a spouse.
And if you're, let's say the earning spouse, let's say the husband or the wife, whoever it is that's the earning spouse, that doesn't have a great retirement at work, that $7,000 might be served better in the spousal IRA, So, you have to make sure to look at both those and kind of see what is the better option.
Yeah, sometimes the options available for public employees are not
The best.
Yeah, the best.
Yeah. And that is something that's important, because obviously if you get a match, that's 100, well, it could be 100%, could be any percentage, I guess, but that's free money. You definitely want to make sure you're taking advantage of that first before you think about an IRA. So that's for sure. But then after that point, sometimes you can look at, maybe it's both, hopefully it's both at some point, but it could be an either or if the finances, that's all it allows. One thing that's great about an IRA is there are literally thousands of different investment vehicles you could contribute into, and some are extremely low cost, whereas a 401k could be very, very limited, and in fact they are limited and sometimes have very high cost involved.
Very, very much so. Yeah.
So lots of things to consider when you are investing in an IRA and a 401k, but there's obviously some things you want to avoid, and hopefully this episode has highlighted a few of those. Once again, if you would like to, if you think you're ready to start working with some professionals, we got a couple of them here at the table. Once again, Bob Schwartz Financial, bobschwartzfinancial.com is the place to get more information, and these gentlemen would love to work with you. Once again, if you're watching us on YouTube, do all the things, subscribe, hit the thumbs up, and on your favorite podcast platform, give us a 5-star rating. We appreciate you joining us. Until next time, have a great day.
Thanks,
Yeah.
folks.